Hello, Christian. Equity markets rallied strongly in the first quarter. In March, the rally broadened beyond the Magnificent Seven names. Can this continue, or is the party going to stop at some point?
Markets have certainly been off to a strong start for the year, and this comes on the back of an ebullient 2023 and what were already very stretched valuation levels. And any sort of inconvenient data point that has been coming in hasn't done anything to dampen the euphoria in markets. It reminds me of the old John Templeton saying that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, but then they die on euphoria. And at First Eagle, we concern ourselves about protecting our clients' assets on the downside. And when I apply that lens today in the current environment, I do see some warning signs that do warrant some caution. The first one relates to inflation. We just don't see the landing in a soft landing narrative. If you look at the inflation data, core CPI in January and February coming in at 3.9, 3.8% respectively, those weren't very positive data points. You look at the monetary aggregate, which has started to grow quite a bit again after bottoming out in October of 2023. And then you look at the wage data, most importantly. If you look at the Atlanta Fed wage tracker, wages are still growing 5% year over year. The labor market remains tight. And in an economy that is built on services, which by definition are very labor intensive, that is an issue. So proclaiming victory over the inflation just seems a little bit premature to me. That's the first warning sign. The second warning sign comes on the fiscal side. We have been uneasy about the large fiscal deficits during a time of generational low unemployment rate for a while, but it seems now that more market participants are waking up to that inconvenient reality. You had the Congressional Budget Office repeatedly say in the last few weeks that the current fiscal situation is unsustainable. Olivier Blanchard, the former chief economist of the IMF, came out and said he's very worried about the magnitude of the deficits and the lack of willingness to do anything about it. The US isn't the UK, but we did see in the UK under the short-lived premiership of Liz Truss what can happen if financial markets lose the confidence in the fiscal soundness of a budget proposal. So yes, markets are very strong, but I do see warning signs in the form of inflation and the fiscal situation.
Let's connect that to fundamentals, and let me ask you about valuations. So are current market valuations justified? And as we look across geographies and sectors, are we seeing bifurcations in where it might be justified and where not?
So if we start out in the US, valuation certainly seems stretched. If you look at the S&P 500 on a price to cash flow basis, it's trading about 2 standard deviations above its historical average. What that means is 98% of the time, historically, the S&P 500 has cleared at lower multiples than what we see today on a price to cash flow basis. Now, US markets are expensive and the rally has broadened. However, there are some pockets within the market that are a little bit less loved, that embed slightly lower, more moderate valuations. And sort of as a rule of thumb, it seems the further you stray away from AI, the more attractive the valuations today. So some areas where we do find value today include energy, where the fundamentals are quite sound. And dare I just to say, if the whole AI euphoria plays out, we'll need a lot of energy to power all of these data centers that are required. A second area would be real estate. Especially in the publicly listed markets, real estate assets are trading at very attractive valuations relative to their replacement value. Now in real estate, you want to be selective in terms of geography and the nature of assets. And then a third area would be consumer staples. These very resilient business models just hold a little bit less allure during a raging bull market. So those are just a few examples where we do find value. Now, if you leave the US, valuation levels drop off quite a bit. And we've been saying for a long time, the US doesn't have a monopoly on great businesses. So if the US is the starting point at a 5% earnings yield, you go to Japan, the earnings yield is about 6%, but on a lower cost of capital. In Europe, the earnings yield is 7 to 8%. And in emerging markets, you may get 10% earnings yield. Now, when you look at our international holdings, many of them are truly global businesses. But by nature of the headquarter being in a jurisdiction outside of the US, the earnings yield is a lot more attractive. So yes, valuations are high today, but with our go anywhere approach, we're still able to find attractive opportunities today.
Thank you very much for your thoughts today, Christian. I look forward to speaking with you next month.
Thank you.